Hello there. My name is Scott Marker, and I'm with Network in Action. I'm the franchise owner here in the Treasure Valley. They're based out of Houston, Texas. I'm the first one here in Idaho. I was number 27. Now we have 75 across the country. I bring together local professionals once a month to try to help each other businesses grow. And off of that, after talking to a lot of people, I decided to come up with this podcast called Treasure Valley QuickTips and bring in local experts in their field and just try to pass on some wisdom, because a lot of times we get our own little fields and we think everybody knows it, but they don't. So today I brought on John. So John, introduce yourself.
Hi, John Rynhart with Primary Residential Mortgage. I appreciate you taking the time out to do this interview, Scott.
Hey, no problem. Hey, I've listened to you before, and know that, when it comes to mortgages, because you do mortgages, right? All types of anything to do with mortgages for residential, you do it every which way. So what, a lot of times it's like, why should someone come to you and your team at the PRMI versus, going to a bank and getting your mortgage done?
Well, I think for most people, buying a house is the biggest purchase they're ever going to make in their entire life. If it's not the first house, it's the second house or the third house or whatever. And you're talking, you're not buying a car, you're buying a house.
Right.
You're talking about financing hundreds of thousands of dollars.
Yeah.
And when you do something like that, a major thing like that, you want to have somebody in your corner that is not only knowledgeable, but motivated to help you. And I think that what sets me apart from other lenders and what sets my company apart from other lending institutions is the fact that we go the extra mile. We're the one-stop shop as far as financing goes. There isn't a type of loan I can't do, purchase or refinance, that I can't find a niche. I can't make it work. My job is to take a look at somebody's situation, see what their goals are, how much house they want to buy, how big their payment they want to be, and to set up the parameters and make sure that what they want is something that they can get. And if they can't get it today, what kind of timeline are they looking at? I was up till 1 a.m. last night working with a client because they had an offer that they wanted to put in on a house.
Wow.
And, and it was time sensitive. This is a hot real estate market. And,
oh yeah.
I don't know very many lenders that would work with a client till 1 a.m.
Yeah.
But I did, that's what was called for.
Right.
And that's, I rise to the occasion. I mean, part of the problem is that I'm a baseball fan, and the baseball game was on for a little bit earlier, and I coached my son's baseball game, and he had a game. So basically I flexed my time, and the customer needed it by a certain time, and that's what I did. And that's one of the reasons why I'm in this job, is because I have that kind of work ethic where, what needs to be done gets done today.
Right.
And I rarely put off work till tomorrow, because you never know what tomorrow's going to be.
Yeah, yeah, and you're right. You're right. That's real important.
I think a lot of lenders, especially banks, they're 9 to 5. Their weekends off, their holidays off, and that's just not that's not ideal for this type of market, this type of world where you have to get an offer in, you have to be competitive, and realtors come to me to partner up because they know that I'm available for them. And banks and stuff like that, I mean, I don't think your chances of getting a lender to work with you late into the evening are very high, but that's what sets me apart from other people.
Cool. So you guys can pretty much do all different types of, whole variety of any types of refinancing and loans, and then also, which I've heard before, go above and beyond, which in this market, we're here in the Treasure Valley, Idaho. Holy freaking smokes. I grew up here, 3rd generation Idahoan. And every time I think the real estate market's gotten crazier, it just gets crazier. Housing prices and everything.
these are unprecedented times we're in right now, and you need somebody you can trust in your corner.
Yeah.
That's gonna do the thorough job on your loan to make sure there aren't any major hiccups.
Yeah. So right now, prices, I mean, every month it seems like for, I don't know how long, I don't know. I mean, have keep going up, up, up. So why you're going to get, I'm sure you're going to get a bunch of fence sitters or whatever, sideline sitters. They're going to go, well, maybe I should wait to see if there's going to be an adjustment or something. So what do you think about if someone comes to you and says, we really want to buy a house, maybe we should wait, 6 months to see if things adjust and the rates, the prices of houses go down somehow?
Yeah, there's a lot of fallacies with that kind of thought, and I have this talk with people quite a bit. Well, right now we're dealing with accelerated market values. Houses are going up. What used to be a very, very affordable area is now less affordable because of the amount of people that are coming here.
Yeah.
Idaho specifically is one of the most moved to states in the whole country. In the Boise Valley area, the Treasure Valley area in particular is the hotbed of it because there's so much industry and job opportunity here. What's happening right now is we have a national housing shortage. And you put that with a hot real estate market and low interest rates, which is what we have right now.
Right.
And it creates this like almost feeding frenzy type of situation here. And the solution to that is to get yourself a good realtor and to get yourself a good lender who can put you in the best possible position to get your offer accepted, even when there's multiple offers. The reason why it's so important to buy now rather than waiting is just because you sit and you wait and two things can happen and are almost certainly going to happen. You're going to have prices go up on houses, continue to go up. So the same house you could have bought for $350 is now $400. And your mortgage payment, if you want that same house in 6 months, is now $400. The other thing that can change, and we saw it today, is interest rates can go up. They're still very low. We're at probably at the 95 to 98 percentile mark as far as interest rates. And, the market is going to correct. Interest rates are going to go up. Housing is having trouble right now because the market can't keep up. We're having supply issues with building houses right now, where houses are costing more to go up because building materials are scarce and more expensive and hard to find, and people are paying top dollar for more, and they move that cost to the consumer. Inflation is a real major concern in this country right now, and it's directly correlated to the housing market. And so you get this house at $350 now versus $400 next year, and you get today's interest rate, and you get today's pricing. Now, tell me what job you can make $50,000 tax-free, right? That's tax-free income. And how many hours do you have to work to make that kind of money? Yeah. I mean, some people are uber rich, but the 90
most people here in Idaho, that's a chunk of change.
$50,000 tax-free is $75,000 worth of income, and that's as much or more than what the median income is in this valley. Right. So you can actually live in a house for what you're paying, what your job. Yeah. And so people that wait are going to pay the price, and some have already paid the price to a certain extent, but it's just going to get worse. It's not going to get better. Interest rates are going to go up. People are always thinking that there's going to be this housing crash. The housing markets rarely crash. They level off. What happened 12 years ago was the product of loose lending laws that have been like the pendulum has been completely corrected so that that's not going to happen again from a lending perspective. The people that are in houses right now truly deserve to be in those houses. I and every other lender in the country vets them out with documentation and work history and income and money saved and so forth. So the people that are getting houses now are the ones that deserve it. And that's what caused the crash 12 years ago. And that's not going to happen again. It's unfortunate that it's in everybody's recent memory.
Yeah.
But housing prices are where they're at, and I don't see them going down. The worst case scenario is that they level off.
Yeah.
And
It's funny because one of your partners you know that you deal with, Isaac, he was on my podcast a year ago and then came back on again, and he predicted you better buy a house, because here in Idaho, other places might be different, but you're going to be paying, a lot more money in a year from now. And man, when I did my last podcast, it was like so spot on. Now you have the high prices, and then interest rates go up, and that's you'll be double trouble on sitting on the fence and kind of waiting around until the perfect storm happens, which you'll find out. Anyway. So okay.
And the other thing is that inflation causes housing prices to go up too, because the cost of building materials, everything gets more expensive, and you get locked in at today's cost to build a house, and you're not stuck in that trend. And people that sit and wait when they have the opportunity to buy really end up regretting it. I deal with customers on a regular basis that are like, man, we should have bought a year ago. It's a much more competitive market, interest rates, and it's unfortunate because I don't get any gratification from saying I told you so.
Right.
I mean, that's rude and insensitive,
right.
and it doesn't accomplish anything. But it's the reality, And I don't ever say that. I would never say that to somebody. But the best thing you can do is get your foot in the door somewhere, even if it's less of a house than what you would want ideally, and get your foot in that door.
So why so you buy a house right now, you work with them, and they works out fine, they get themselves a house, and they're going to say, well, now I have a big house payment, right? Versus renting somewhere here in the valley, which is a challenge, believe me, a huge challenge. I don't rent, I own a house, but I just read the paper, the news all the time, and listen to it, and the renting prices here are through the freaking roof. So why is having a bigger mortgage not always a bad thing?
Well, the talk that I have with people more often than not, when they're worried about, well, we don't want our mortgage to be this much because we have, this amount we have to save each month.
Right.
And what I do is I try to readjust people's mindset on what a house is. They think, oh, it's a mortgage payment, it's a liability, it's responsibility, it's an obligation that I have to pay each month. And it's true, it is. But the mindset change that you need to have is that your house, for 90% of people, is your biggest investment.
Yeah.
Unless you're uber rich, your house is your biggest investment.
Right.
And therefore, when you have a larger mortgage payment, more than what you're used to, it can be a little bit of a shock. When I bought my house, I was like, wow, that is a big mortgage payment. But after about 6 months, maybe 5 months of making that payment, it's like, that's the new norm. And you don't think of it as that anymore. And what you have to think of a mortgage payment as, being that it is your largest investment, is that a house is going to make you money.
Right.
It's an investment. It's like what we were talking about before. It's a tax-free investment. You get to write off your interest on your taxes.
Right.
You get to have that security of knowing where you live, and your landlord can't raise the rent on you. You are in full control of that. But most importantly, it's a savings account. It's a savings account that not only do you get to live in it and use it and have provide for you and your family, but
right.
It's a savings account. You are building equity in your house. And the only way to do that is to make a mortgage house. Right. And like what I said before about building up the kind of money that, like, serious money, serious capital, $50,000 tax-free in 1 year just for living in a house. You can't make that. And so what I tell people is are you investing money right now? Are you saving money? Are you playing the stock market? And they're like, yeah, well, how about you invest in a house that's going to make you way more money and be much more stable of an income source than cryptocurrency or stocks or whatever. the housing market is the most stable market in the country because it's based off of bond rates that are set by the federal government, the 10-year Treasury yield. And it's very stable. And you know what you're getting, and you're going to be getting a rate of return that you can't find anywhere else. And that goes for 90% of people. Some people have millions of dollars, you know, and their house isn't their biggest investment. But for the vast majority of us, me included, your house is your biggest investment.
Yeah.
And therefore, you got to treat it like a savings, like a savings account that you live in.
Right.
And you have to think of it too.
I actually bought my house right before 2010. And I tell everybody the same story, but I got lucky because it was for sale by owner. He was difficult. So, you know, I didn't pay, you know, like, because it was like now things are going up. But that being said, so I probably bought at the high end, not the highest, but the higher end. And my house now is worth, I won't save it, like a considerable lot more. You know, 12 years later, it's worth a lot of money.
Yeah.
I mean, I look at it again. I'm one of those people that I got some money in savings and stuff, but I take a look at how much the house is worth, and you know, it's like holy smokes. I mean, it's been, you know, it's been nice. It's just been nice to look at the house and go, you know, you know, down the road someday, if I ever wanted to sell this and downsize, I got a chunk of change.
Yep.
You know, which you know. So I'm you're singing the choir on that one, because like I said, I'm the perfect example of a little high probably, you know, but 12 years later, it's worth a ton more, you know, than you know, I won't say over $100,000 plus more than I bought it, and it's just, I mean, that's just great. Somebody
would buy your house, right? Somebody would buy your house if you needed to sell your house. Somebody would come along and buy it for you, and there'd probably be a competition for it, you know, because of this market.
Yeah, and I've talked about that too. Is that the challenge is, though, is then I go, where do I move when the rent?
Exactly.
Because fortunately, I have I have the rates that are right now. My first house ever. Won't go too much in the weeds, but my first house ever. You know, out of college and stuff, and interest rates were like almost 8% You know, so when people now go, oh wow, it's 3.9. Oh no, I'm going, that's free money. So I'm like, you know, I look around at the rent that they're charging around here, and I own a pretty nice house, very nice yard, for someone that's buying a apartment. The same cost.
And the landlord can go, you know what, I'm not making enough money off of this apartment or this house, and they raise the rent on you when your lease expires.
Yeah.
And you're stuck.
Hey, I have a question for you. Why is putting down like more than 20% not always a good thing? You know, let's say somebody, I don't know, pulled some investments out or something because they want to dump a whole bunch of money into the house they bought to get a lower house payment. So what are kind of because you've done this for a long time stuff, what are your opinions on that? Like somebody wanting to put 30% down versus 20?
Sure. You know, anything over about 25%, you don't see any kind of real pricing change. Your interest rate isn't necessarily better. When you put 20% down, you don't have to pay mortgage insurance, and nobody likes doing that.
No.
But you know, every investor that's ever come to me, they don't want to put more than 20 or 25% down on a house, because the reason is simple. I'm loaning money at 3%, maybe 4% on an investment property.
Right.
You can make 4% easily on the open market. You can invest that money and make 5, 10, 15% right now. When you put it into your house, you're going to get a 3 or 4% rate of return on that money. And the interest rate is almost exactly the same from 20 to 25. I mean, you really have to be over 50, 60% equity in a house to get a really serious rate difference. I mean, and maybe it's only 0.25%. It's not major.
See, now, that's something that right there, that's something that, I mean, now you mentioned, I would have thought before talking to you, I would have thought, well, let's say, I don't know, if I was gifted, I was going to buy a house and was gifted, a bunch of money and I could put down 40% of the house. You would think that, oh, wow, that's going to really lower my house payment every month or get me a fantastic, better interest rate.
It doesn't do that. It does a little bit,
right?
But when you look at it from a 10,000 foot view, and you can invest that money in other places and get a much better rate of return. I mean, 5% is pretty much the minimum you should be getting on anything. And if I'm loaning you money at 3%, why would you not take that extra 2% every year? You're talking about thousands and thousands of dollars squandered just so you can have money in your house. The other thing that it does when you invest money is you have the ability to move that money around. It's much more liquid. When it's in your house, you can't get that money without either taking out a new loan or refinancing, like a HELOC, second loan on a house. And then you end up paying an interest rate on that that's higher than what I can loan it to. So people that come to me, I always have that conversation with them. Why do you want to put so much money down? Oh, I want my payment lower. But when you finance something over a 30-year or 20-year loan, I mean, an extra 10% down it's not going to change your payment very much, and it just locks you up. That money gets tied up in your house, and you can't access it. And if you do want to access it, you pay money to borrow money from yourself, and I don't think that's sound thinking to do that. So get rid of the mortgage insurance. I always encourage people to put 20% down.
Right.
Maybe 25% depending on their circumstances, because there is a little bit better of an interest rate, but why? And these are very unstable times that we're living in. It seems like money's kind of like monopoly money right now, the way prices are going up.
Right.
And when you tie that money up in your house and something goes wrong in your family, do you want to have to sell your house to get that money to support your family?
Right.
Or would you rather have that invested to where you can pull it out and keep your house and sustain your normal family life? And we all have bad things happening in life, and you never know when it's coming. It may not even be your fault. We all do dumb stuff. We've all made mistakes. We've all been put in a situation where, man, I need $10,000 right now, or the air conditioning unit goes out at your house, or what? We just added a new kid to our family. We need to, build another room, another bedroom for our house. Where do we get this money from? Well, if it's in your house, you can't get it without refinancing.
Yeah.
But if it's on the open market, you can take that money out of your investments and do the add-on.
Right.
And that's what people are doing right now, is they're adding on to their houses because it is hard to switch houses right now. The musical chairs isn't very efficient right now. It's
right.
If you got a house, and most people don't want to give that up.
Right. So that being said, because I know you do all types of loans and stuff. So now you have somebody that wants to take cash out of their house, for for financing or something on. I'm sure you've seen a million different reasons why they do it, for a remodel, for paying off credit card debt that's at 19%.
Yep.
So how do you kind of coach people on that when they come to you?
Well, you got to look at a refinance as a way to restructure all of your personal
right.
potentially. I have literally saved people that make $100,000 a year, over $2,000 a month, because of they've accrued consumer debt, and we do a debt consolidation refinance, which doesn't hurt your credit. It actually boosts your credit because you're paying off these debts. Right now, credit card debt they just changed the system a few months ago, about 6-8 months ago, to where if you're carrying a revolving credit card balance, it hits you harder than it ever has before, because the consumer the credit companies have determined that that's the biggest issue with people and their stability of their finances. So when they're rating you, when you get a credit score, it's oftentimes artificially dragged down by having a high balance on a credit card. So if you have let's just say you have $1,000 limit on your credit card. If you spend more than 20 or 25% on that card, you're at risk for having your entire credit score go down. So if you spend more than $250 on that card, your credit score is going to take a hit. So it doesn't matter that it's $250, and most people make that in a day, but the difference is that the credit scoring companies, they don't see it that way. They see it as $1,000 where you're over 25% of your balance,
Right.
and they penalize you for it. You know, with credit cards, you're paying much higher interest, maybe 20%, some people, depending on the card.
I have a good credit score, and maybe that's why it's ticked up even better recently. Is I don't have any credit card debt at all, and I checked the interest rate. I don't know, I remember what it was, but even with good credit and stuff, it's high. I mean, if I had bad credit and a bad credit score, I just can't imagine what people are paying for credit cards right now, because anyway, it's just like I said, it's just astronomically expensive. So you help people, so they come to you and they'll have an existing home, and maybe they want to do a debt consolidation. So what do they kind of come to you, and you sit down with them and they go, here's all the debt I have. What can you help me with? I mean, is it kind of
exactly it. I take a global perspective of somebody's finances. Okay. And I get to see their credit report. I get to see their debts. I get to see what their minimum monthly payment is on all of these cars, and these cars and, you know, RVs. People like their toys, you know, they like to have stuff.
Yeah. And those are a lot of those toys they have are, a lot of those toys they have are also on not always, but sometimes they're also financed too.
Well, that's what they would, if they were financed, they would be on their credit report. But what you do is you take a global look at everybody's finances, and you can go, look, if I refinance you and consolidated all of this debt into your home mortgage, this is what your monthly obligations on your bills would be. And we're talking about thousands of potential dollars saved every month, tax-free, just because you realign your finances. And what the common objection I hear is that, well, you know, we only have 5 years left on that car, right. Or, you know, I think we can pay that credit card off in a couple of years, whatever. And it gets down to this principle of, yeah, you can pay it off in a couple of years, but what if something bad happens?
Right.
And what if you aren't able to pay it off, and you just keep this thing going, and you're losing money? You know, you've got a hole in the plastic bag, the water you're carrying, and this water is leaking out, meaning interest, the money you're paying in interest, and your credit score is being dragged down in the meantime because of what I just discussed.
Right.
And I can alleviate these bills, but the objection I hear is I can pay this car off in five years.
Right.
Well, what if I saved you $2,000 a month, and you paid an extra $1,000 a month in principal towards your mortgage? Yeah. So I'm saving you money, and you flip that money around and put it right back into your mortgage, you know, where you're only borrowing it at 3%.
Right.
And that's what you do. That's a responsible thing you can do. You can set your loan to pay extra on principal every single month. So if you have this guilt about, well, I don't want to finance a car over 30 years, pay that extra $100 or whatever, just for that car, $200 or whatever you were paying, and save yourself the interest. The other thing is about cash out refis is that probably 2/3 of the fees on a refinance, it doesn't matter whether you're refinancing $100,000 or $200,000. The fees are essentially the same, because we still have to go through the whole process to do a refinance. So people that just want to pay off some of their bills when they could pay off more are actually shortening themselves. They could be saving more money. And the cost of doing the refinance, which is always another thing. Oh, well, I'm going to save, that's going to cost me money. Refinances don't cost any money out of pocket. It's all based on your equity. So you saving, I think I save anywhere, most people, $600 to $1,100 each month on if they're doing a debt consolidation. Some people are up at $2,000. But you flip that right back into your mortgage, that in extra principal payment, and you paid off your debt faster because you're not paying it in mortgage. And I'm not going to, you don't get, we don't ask for any money at closing unless you want to bring it in. Very few instances do clients ever have to bring in money to close it. And usually the only time is when they're close to that 20% down to avoid the mortgage insurance. And we just need $1,000 or whatever to get to that 20% mark. And then they lose the mortgage insurance. But that's totally worth it to do that in that case. But probably 19 out of 20, maybe 24 out of 25 refis that I do, people don't bring in any money. It's all based on the equity that you have in the house.
Oh, see, okay. So okay. See, again, you just doing what you do. Perfect. Well, hey, we're gonna have to wrap this up. I do want to end on a little a shout out to you from somebody. It's just it's weird how just the other day I talked to somebody. I won't use their name, but they heard you do a little talk about just kind of like this, kind of talking what you do. And he said he talked to his wife and said, we probably should look at. And he told me his interest rate, and I'm like, geez, what are you doing? And anyway, he came to talk to you, and he says, you couldn't have been a better. You did a great job, easy to work with, and you saved them almost $1,000 a month. I thought that is, and they make pretty good money too. So it was like, I thought that was pretty good. So that's a good shout out to you, as I'm going to say. It was funny because I knew I was going to do this interview, and then, whatever, 2 days ago, whatever, he just goes, hey, I want to talk to you. I said, okay. I listened to John, and then he told me this story. I went, wow. And I said, well, how much was it? He goes, it's almost $1,000 a month. I went, wow, that's not bad. I mean, you took him down from 5 to 3 something, So
yeah.
And again, that's a great success story.
I have, you can go on my Google page and see the reviews that I get. And, I will decline a loan if I think it's not in the customer's message. I will say, you know what, this is not something you want to do. If you do a loan with me, it's because I really feel like this is going to benefit you. Seriously. And it's going to be worth, the hassle of going through a refi, which quite frankly, depending on whether there's an appraisal or not, we're talking maybe 2 weeks, 3 weeks to close a deal on a refi, maybe closer to 30 days on a purchase. But thank you, Scott. I appreciate you doing this interview, and look forward to seeing you next week.
Perfect. Hey, appreciate it. Have a great day. Thanks again.